Welcome to the Registered Investment Advisor Podcast, where financial services marketing expert Seth Green interviews experts, executives, and top producers to share can't-miss tips on how they successfully manage their financial service firms, grow their businesses, create great relationships, and influence the industry. And now, here's your host, Seth Green.
Good afternoon, everybody. Today we have the pleasure of having Mustafa Ladha from Veloce, from Veloce Capital, a premier real estate investment firm. And I'm really looking forward to this interview today. I've had an opportunity to take a look at the website and do a little due diligence, and I am really excited to hear the answers. Mustafa, thank you for joining us today.
No, thank you so much, Karl, for having me. It's a pleasure.
Well, pleasure is indeed mine. Now, can you elaborate a little bit on your background in the real estate realm and how, you're it's a family business, how it all works together, and what led you to become a fund manager?
Yeah, sure. So a couple different questions you asked there. So I'll try to unpack it and, stop
Absolutely.
me or ask me to dive a bit deeper if you have more questions. But fundamentally, I started working in the pharmaceutical industry. And at the time when I started my entrepreneurial journey, I kind of, created different businesses on the side, exited them, just figuring out different ways to make money. And at the time, I noticed a lot of my peers who are working in the traditional 9 to 5, sometimes you don't have access to different investment opportunities, or you don't have access to like the know-how of how to do due diligence, how to figure out, what fits your criteria, because there's no right answer in personal finance. It's very unique to your goals. So that kind of led me to, ultimately pursuing my own entrepreneurial journeys. I ultimately, had some good successes. And then I came to my family business, Veloce Capital. And the question was really, how do I add value? And so I was tinkering with the two things. And really, I realized that, fundamentally, a lot of us are looking to make money, but we don't know where to start. And sometimes, investments aren't really at our fingertips. And you see that a lot over the last couple of years. You see, platforms like Robinhood, platforms like, Peer Street, all these different, platforms that, address the central problem of making investing easier. And so that's really what I structured to do with Veloce Capital, opening up different investment funds to, reduce minimums, to have more of a crowd fund, look and feel, to have, I know it's a finance podcast, so people are probably familiar with like Reg A and crowdfunding and basically accredited and non-accredited investors. But basically the goal was to take something that's, only available to ultra high net worth individuals and really scale it down so that you can get involved no matter how much or how little capital you have. And that way you can get your feet wet. And then as you start to get your feet wet, as you start to make more money and scale, then it opens up a lot of different possibilities. And so ultimately at Veloce Capital, the goal is to deliver more ways to invest. But the rationale behind that is to really educate our clients, our partners, to say, hey, this is how we can add value to your portfolio. And then ultimately, these are the things you should be looking for in your portfolio as well. Because as an investor, you know that no one person can provide you all the services you need. And if they are, in my opinion, they don't always have, hundreds of years of experience in that, serving every vertical. So that's kind of, when I look at it as an individual investor first, I look at, okay, I want to partner with the best in class in each problem set. And then like that, you build out a team that's a best in class team, if that makes sense.
Your approach. I've said a couple places where you don't have to be an accredited investor to get started. That's a great thing. How do you ensure that your strategies are not only financially rewarding but also ethically grounded and still make money?
Yeah. It's never easy, right? So ultimately,
Yeah, sure.
we invest in and we advertise strategies that we ourselves have invested in, right? So Veloce Capital started as first managing our own capital. We've been in the business for over a decade. We've deployed over $1 billion in transactions. We manage over 100 million. So for us, in terms of like track record, it fundamentally started out as managing our own capital as a family. Until today, we still we still invest our own capital in developments. So we're invested in the projects, but that doesn't mean, in transparency, that doesn't mean that we're invested in every project, right? So there's a couple of different structures. Like in some structures, our capital isn't necessarily invested just because there's so much demand from our investor base. So in those situations, we're not investing our own capital. But then we look to align our interests with the investor as much as possible. If that means, less upfront fees, no fixed AUM fees, no asset, purchase or disposition fee or refinance fee. So we look to keep it as lean as possible. That way, ultimately, as an investor, I'm asking whoever's raising capital, when do you make money? How do you make money? So when I get asked that question, I love it because I can point to a deal and say, hey, I'm making money in year 3. So now how can you as a business keep your lights on for 3 years without making profit? You have to have that robust, you have to have the capital, you have to have the confidence in your product and your investment, but also you have to be investing your own capital. You have to have other means of generating revenue. So first and foremost, I think to answer your question, Karl, we approach it with the investor mindset because that's who we are at the heart of it. We're investors as well. And the most important thing to an investor is our reputation, right? As an investor, you want to get the best deals. So you want to be somebody who can always deploy capital. You want to get the best deal. So you want to be a good partner to work with. You want to be responsive, etc. You want to, make sure you're doing everything along the way to mitigate risk. Because if I'm an investor and I bring my friend as well to invest with Karl, for example, and I lose money, I'm upset. My friend loses money, I'm more upset because it also affects my reputation in the industry. Yes. Next time I can't go to my friend and say, hey, listen, I'm making money with these guys, you should invest, because he's my friend, so I didn't burn the bridge per se, but my reputation takes a hit. And I think that's the thing, Karl, when you look at it, especially today where there's a lot of, different investment options, and really over the last couple of years, you've seen with, social media and everything that there's more accessibility, which is really important. But that's when it becomes even more important to ask the tough questions or the starting out questions that you're asking in terms of due diligence, because it's important to partner with somebody that has the same mindset as you, because a syndication or a real estate investment, typically you're investing 5-10 years. So you don't want to wait that long to realize your first major liquidity event, or to get your capital back, or to say, oh, hey, it was a good investment or it wasn't, because then there's opportunity cost of time as well. So for us, there's a couple of different things, Karl. We look at the quality of the investment. We look at the track record. We look at how quickly we get our money back, our initial investment. And then if it hits those boxes, then we'll deploy capital, or we'll talk to our investor base to see if there's interest, and we'll raise capital. And that's typically how we structure it.
Okay. No, I've been really waiting to ask you this question. It's mentioned that you guys have raised over 20 million via WhatsApp.
Yeah.
How do you separate the wheat from the chaff? How do you get the real prospects from the tire kickers? And tell me,
Sure,
what's your
sure.
procedure there?
So Karl, that's just me alone. That doesn't, that's not the company. That's just me alone.
Wow.
I think part of the problem, or part of, why I've been lucky, successful, however we want to word it, is how you describe the question. How do we separate, you said like the wheat from the shaft, right? Like who's serious and who's not serious. And the fundamental thing is, like, I don't come from a marketing background. I come from a science background with a lot of, family business experience, right? So for me, working in professional corporate America, I just wouldn't understand why people do things a certain way when, the goal isn't, especially in like pharmaceutical company, I was in drug development. So the goal is to save lives from my perspective, not to make money. So I wouldn't understand, why people will make different decisions to not optimize profit as well as saving lives, because you can do both from how I look at things. So when I transition to really working or building out, my businesses, it's the same mentality. How do you add value for people without compromising any of your values, right? Like we talked about like ethics a little bit, but to me, that's the most important thing, especially when you're taking somebody's, somebody's giving you their trust and putting you in a position where you're responsible for their hard-earned money. That protecting, that's the most important thing. So that's, the mentality I come at it with. And then as an investor, you're looking for somebody to earn your trust, right? Like money is infinite. People might have, $5,000, they might have 5 million. But how do you know if that investor that's investing 5,000 with you has 5 million? You don't. You only know that you got 5K. You send them documentation, they marked accredited. So they might have 1 million in assets. Now that 1 million in assets might be illiquid for 20 years. You don't know, right? So you can, to some degree, you can never separate that. You can only say, hey, listen, this person has deployed X amount. But just because they deployed, $5,000 doesn't mean their value is $5,000, right? Because they're a person. We wouldn't like, it's not transactional, it's a relationship. Especially, in the RIA space, in the real estate space, everything is building a relationship. So to me, it's not really about separating the shaft and the wheat, although, it's challenging because the bandwidth, what we don't talk about is like the time required, right? Time isn't infinite. I'm not going to be around here forever. And so similarly, from a marketing perspective and a business development perspective, you want to spend your time on what's most efficient to grow the business. And to me, the way I spend my time in terms of growing the business is understanding how can I add value the most, right? Because fundamentally, if it's a relationship, game, so to speak, and if my mentality is that I want to build the strongest team, which is how I think, so then I want to partner with people who think the same way. Now, if that person has $5,000 and they're 22, I'm young, you're young, we're not thinking we're in the business for a year. So fine, invest $5,000. Let me earn your trust. Let me deliver for you on $5,000. Next year, we'll have a conversation. Invest another five. Don't invest. If you say, hey, Mustafa, I can't invest, no problem. I have no liquidity. I'm not going to ask you questions, right? But if the goal is to develop that relationship, then what is the path to develop that relationship and earn the right to have that person's business, right? And I've had, situations, Karl, where people in the WhatsApp group have, started with 10K, delivered for them double-digit returns. They've grown to 50K, delivered for them double-digit returns. They've on an annualized basis. They've continued to invest, and then they call me and they say, "Hey, Mustafa, I'm having a $2 million liquidity event. What should I do?" And I'm like, honestly, like I've never met you face to face. This is, I've had a couple conversations. What are your goals? Like, I can't answer that question for you because, like we mentioned, it's personal finance. It depends on your goals. And then he'll break it down. So like, I'm not, a financial advisor. I'm not a RIA. So I'll, say all the disclaimers like, listen, if it was my money, this is how I would handle it. But you have to look at the tax implication. You have to look at what you want to accomplish, and you have to look at liquidity, because everyone can pitch you any strategy. Everyone can say, this is how it's going to develop. But fundamentally, if you have an emergency and you call me, I will do what I can. But if you've invested in a strategy where there's, no liquidity for the first 3 years, and then you get all your investment back, in real estate terms, that's a very quick time frame. And I can do that. And we have done that. But you have to wait 3 years. So if you have, a life event in the next 3 years, then it wasn't the right strategy for you. And so fundamentally, Karl, when it comes to separating, investors or clients or prospects, that's not my strength. And I own that, because to me, like, I look at the relationship, and ultimately, if that person has a growth mindset, which you're not going to see on LinkedIn as a job description, you're not going to see on a WhatsApp as a banner, I have a growth mindset. You're going to only know that by talking to the person. If they have a growth mindset, if they're looking to develop that team, then I'd love the honor to be a part of their team. And I can bring all the resources that I have, whether it's, accountants, whatever you're looking for, financial advisors, all those different things. And I'll say, hey, here are people that I've spoken to, I've talked to, who I think are good. But ultimately, you have to speak to the person that kind of resonates with you and that understands your vision, right? Because I'm just one part of the team. And that's really how I approach it.
Okay. It seems like it's kind of a cross-educational process. You're educating them on you, and then at the same time, they're educating you into, what their goals are, what they're looking for, where they fit in. That's kind of cool. That's
You love it. I can tell you're smiling, everything.
man, I love this stuff. I love this stuff. And you've been pivotal in crafting and creating Shariah-compliant investing strategies, and that's new to me.
Yeah,
Can you give me some more information? Can you tell my audience a little bit
sure.
about that?
Sure. So Sharia compliant investments are basically any investments that, don't have leverage, they don't involve alcohol or pork or gambling.
Okay.
So there's a certain
Okay.
subsect of investors that this stuff is important to. And when I say this stuff, I word it like that because to the average, I assume your audience is American. To the average American, this is not something that we're aware of necessarily, right? So this is, primarily important for like the Muslim investor. And if we look at like the population as a whole, there's a decent amount of people in the world that are Muslim, right? So
Absolutely.
fundamentally, for me, when I look at it and when I look at, whose needs I can address the most, it's about who do you understand the most, right? I'm Muslim, that's my background. And I understand a lot of people don't have access to investments like I mentioned. And then at a deeper level, that sub niche, so to speak, is, Muslim investors that are looking to invest with their, in line with their faith, in line with their religious beliefs. And they're not looking to sacrifice their religious beliefs for 1, 2, 5, 10 extra percentage points a year, right? So that's, the trade-off that they're looking for. And then unfortunately, sometimes they don't have access to investments just because it's a subsect, and real estate is traditionally very leverage heavy. So typically you're looking for, build and sell model, something like that. And then, in the space of real estate, there's less developers out there who are going to structure it kind of in line with you, or there's less diversified funds that are going to build it out in line with you. So that's, really what I look to do is I look to understand, different problem sets and how can we build out a solution around them. And another good example of that would be, retirement and investing in real estate using your retirement accounts.
401s, yes.
Yeah. So like a lot of people aren't familiar, right? You can, you have your 401k, it has access to different investment options, different ETFs, but then you can structure self-directed IRAs to then invest in whatever you want. And that gives you more flexibility to invest in real estate and to really plan out your retirement with more granular detail, because you can understand how rent will rise and how that'll impact your cash flow a lot easier than you can understand what's going on with Tesla or Microsoft or Amazon, because it's just a bit more volatile.
And if you use your 401k, you can still defer your taxes. That's correct?
Exactly. So that's the beautiful thing. So the way the process typically works is you have a 401k, and let's say you leave your job or you retire, or there's some quote unquote qualifying events. Now your 401k isn't tied to your employer anymore. And this kind of ties also into like the educational aspect of what we're talking about with like me educating prospective clients, them educating me. So now they realize as an individual, they have 40K, 100K, million, whatever the amount is in their 401k. And in a lot of our mentality, it's the 401k is illiquid. We can't touch it till 65. So now I, as an individual, view that money as less risky, because either way I'm contributing into it and I can't access it. It's not going to help me until 65 if I'm alive, which would be a great position to be in. So let me invest it in things that, make sense for me, that I want to test out, but I want to test it out with money that I couldn't access anyway. And that's why I would refer to it as, less risky. A dollar is still a dollar, no matter where it is, but it's a bit less risky because you have that time. And either way, you had limited options anyway. So a client would come in and he'd say, hey, I'm looking to structure an investment through my retirement account. How do I do that? I'd say, no problem. Here's a partner that specializes in managing these accounts. They'll cost you like $400 a year, which in a lot of situations is worth the expense because it's nominal. Your ETFs are charging you more and it's not clearly disclosed. So it kind of just, depends. And then ultimately, if they like the custodian, if they like the investment structure, they'll set up a self-directed IRA is what it's called. So the 401k, the retirement money, will be transferred over to the custodian. They'll set up a self-directed IRA. And then you as the investor direct it. You could invest with Veloce Capital. You could invest in whatever else you wanted to. There are certain caveats like, collectible coins and collectible baseball cards and things like that you can't invest in. But in terms of real estate, you can. And then it becomes pretty exciting because then we're looking at those options that are high taxable options, but your taxes are deferred. So now those options, you have to run the numbers to say, hey, I'm at a 50% tax bracket. I'm making 12% return, on an annualized basis. And I have a 1-year investment period. So it's highly liquid and is growing tax-free. That compounds over time is better than maybe this other investment that leverages cash flow and depreciation and a negative K1, because you can't benefit from those beneficial features because it's already tax deferred. So it's kind of like you're comparing the different structures, and what normally would be the best investment might not be because you're investing through a tax advantaged account.
Okay. Makes sense. Now, can you share some specific examples of some successful ventures that you've been a part of and how the investors benefited?
Yeah, sure. So right now, for example, we have a lot of investment structures where clients are coming to us. It's, Q4, end of the year. So they're coming to us and they're looking to minimize their taxable income, right? So they're looking for investments that will give them a negative K1, right? So a typical structure, the way we do it is, typically we're able to structure the deals as discounts based on appraised value. So a lot of what we focus on is ground up construction. We have our own pipeline. We invest in the New York City MSA. the New York City area, basically. We invest in a secondary tertiary market 30 to 45 minutes outside of New York City. So it's in the East Coast. There's a lot of demand, and it's a very strong market. And it happens to be an opportunity zone. So a lot of these are buzzwords in real estate. So for us, what we typically do is development. Now, what's happened is it's also created a unique opportunity for our clients to, who are looking to save on their taxes, to invest in and own those assets. So they'll come in, they'll invest, they'll make maybe 6.7% cash on cash return, tax deferred, right? So they'll get the negative K1 at the end of the year, meaning they don't owe any taxes on that 6.7% return. And then in year 3, will refinance, they'll recapture all of their investment plus profit. So what that means is in a 3-year period, they own the asset for free. Now, what they end up doing is they end up cycling that money, investing in more assets. And what they've really done behind the scenes, Karl, is they've built a real estate business for themselves. And it's passive because day 1, they might own one asset. Maybe they'll own 50 units. Year 3, they'll go out and buy another 50. Now they have 100, where they don't have to worry about the leases. They don't have to worry about the management. In the case of the deals that we're structuring right now, at the end of the year, they're 2023 assets with bonus depreciation. Obviously, that's phasing out. So it's one of those things that, from an investor's perspective, you've now, more than 2x your time. You have your active day job where you spend 40 hours and you make X amount of money. And you have your passive real estate empire that you're building. And as long as you're patient, which is the name of the game in real estate, in this case, 3 years and instead of like a 10-year fund, you're scaling your portfolio. So now, for example, if you're saying, hey, in 3 years, I'll have to pay for my kids' college. Okay, this is the right structure. You invest 100K in 3 years, maybe you make, hypothetically 140K on just that refinance portion. You get your 100K back and maybe another 40% profit, right? Hypothetically. At that point, you had cash flow for 3 years. You got your 140K back tax-free. Now you can pay your kids, college, or you can continue to invest it and just pay from the cash flow. So and that's why it's important, that educational process, Karl. It's important for me to understand the client's goals and then really build out a structure that aligns with their goals. Because, some people like paying taxes, other people don't. So accordingly, we build out a structure.
Right. Gotcha. So with all your successes, tell me what are your biggest challenges?
So honestly, something like this is my biggest challenge. I'm a very private person by nature. So I love having a one-on-one conversation with you, Karl. You're great.
Okay.
But if I was to post this myself, it would be very challenging. Just pressing that post button would be very challenging. So, one of the things is we're in a space where, advertising and putting yourself out there is really important. I think for me, by nature, I'm a pretty private person. And that's why it's always challenging to, advertise the different offerings and the different structures. And I'll have, clients come to me and say, hey, Mustafa, why didn't you tell me that you had this deal and I missed it? You should tell me about your best deals. And I'm like, honestly, like, I don't advertise like that. I don't market like that. It's more, you tell me your problems, you tell me what you're looking for. And when I have a solution, I'll send it to you. And that's really how, I built out my business. And that's really how I, raise capital and how I structure deals. It's really problem oriented. And so that's what one of the things I'm working on, this year and also into next year is really developing that pipeline and being more proactive about problem solving.
Okay. Well, we've helped some companies with that. In fact, we've helped some people with the podcast. Maybe we'll chat on that later.
Yeah.
But lastly, can you kind of describe your long-term vision for the real estate landscape, the investment landscape out of it anyway?
Yeah, sure. So I think it's one of those things that there's so many opportunities in the market that we're in. We've been in this market for over a decade. We've done over $1 billion in transactions in this market. So we're highly knowledgeable and specialized in this market. And it's been a great ride for investors, for clients of ours, for partners of ours. And for us, that's really where we have a very strong base and where we are looking to scale. At the same time, there's other markets that we do invest in, like Baltimore, like Atlanta. We've done some projects. So it's one of those things, I think, Karl, where fundamentally you want to understand, what is your unique proposition? What are you good at? What are you potentially the best in the world at? And how do you scale there? And then seeing what other opportunities there are outside of that market. And does it make sense? For us, a lot of times the deals we're doing in New York, in the New York City metro area, they're much lower risk because it's arguably,
Okay.
the most valuable real estate in the country, arguably. It's, where a lot of the businesses are, where a lot of the money is. So what that means for renters and real estate and everything is it provides a lot of security and protection. And that's what, fundamentally as an investor, that's what you're looking for. You want the double digit returns, you want the high opportunity, but you don't want the high risks. So how do you create asymmetric risk profiles? How do you create opportunities where the return is so much higher than the risk associated? And that to some degree is in ground up construction in the best areas with opportunity zones where you have tax abatements. So now all the people who would complain that the area that we invest in is expensive from a tax perspective, now you're not paying that much in taxes because of the tax abatement. So the government at the federal and local state level are telling you, hey, we want you to develop this area. And that's why, having the right team is important, because you understand, hey, what are everyone's goals? If everyone is, swimming in the same direction, it's so much easier for everyone to scale. And that's really how I approach it, Karl.
Okay. And can you tell my audience how to reach you?
Yeah.
And what's really great is you're looking for accredited and non-accredited investors. So broad spectrum there. Can you let us know how to reach you?
Yeah, I think one of the best ways would be maybe on LinkedIn. You can reach me at Mustafa Ladha. Another way you can email me. It's ml@velocecapital.com. Those are probably, the two best ways to reach me. And then ultimately, just let me know what you're looking for. If it's, to have a conversation like this, more than happy to set that up. If it's to, dive a little deeper and really build out a solution. Ultimately, the thing is, as a society, as a community, especially maybe in like my community, we're not really used to communicating our problems. But the flip side is that your problem, like I mentioned, the problem about podcast, and you nicely mentioned that you guys, do a podcast, which I didn't catch when I looked at, your LinkedIn, right? But it's one of those things that, my problem could be your solution. It could be what you're good at. And, as a society, we're not accustomed to saying, hey, this is my problem. This is my dirty laundry. This is what I need help with. But on the flip side, we want the right person to target us and to advertise to us and say, hey, I have your solution. But then if it's done too targeted, we feel uncomfortable. So it can very easily be that there's a no-win situation. And that's why the way I like to approach conversations is, listen, I'm here to add value. If that means you're looking for real estate, awesome. If that means you're looking for something else, no problem. Let me know what you're looking for. If I have someone in my network who can add value for you, I'm more than happy to make an introduction. And, hopefully it'll help you and the other gentleman or woman, and everyone scales together. That's really how I view it, Karl.
To my audiences, thank you for joining us today. Thank you, Mustafa Ladha from Veloce Capital, for joining us. This is Karl McKinnie, co-hosting the Sharkpreneur podcast with Kevin Harrington and Seth Green. We will see you guys and talk to you the next time.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.